Welcome. We're the Gambling Databases research team.
And we're dedicated to delivering these in-depth analyses of the global iGaming landscape.
We basically take all this dense source material, market data, regulatory filings, economic reports, and we try to pull out the essential knowledge you actually need.
Our goal is to give you a clear, data-driven picture of how the industry really functions in each market.
Exactly. What makes it tick? And today, we're focusing on Canada.
Canada is, well, it's a fascinating study in contrast. Our analysis shows this rapidly evolving iGaming market that has undeniable consumer demand.
Right.
But it's paired with an incredibly complex regulatory structure. It's very high opportunity, but also high friction.
Yeah, we assigned Canada an overall market attractiveness rating of 8.2 out of 10, and that's a strong score globally.
It is.
But given the complexity you just mentioned, that rating, it really demands a critical look. Where does this market truly shine, and what are the major hidden traps?
Let's start with the economic foundation, because that's really why that 8.2 exists in the first place.
Yeah.
Canada is not a frontier market. It's mature. It's highly developed. Their population is sitting at around 39.2 million by our 2025 estimates. And critically, internet penetration is basically universal. It's 93%.
93%. And a huge GDP.
Huge GDP. Robust. About 2.2 trillion US dollars.
And that economic firepower, that translates directly into player quality, which is the metric that international operators really obsess over.
Absolutely. The market size alone was about, CAD 3 billion in 2024, and we're projecting a really healthy annual growth rate, a CAGR, of somewhere between 8 and 12%.
Wow.
But even that's not the real headline figure. The key is the average revenue per user, the ARPU.
Okay, let's pause on ARPU for a moment, because for anyone tracking global markets, this is where Canada really, really stands out.
It's completely different. The Canadian ARPU is exceptionally high. It's ranging from CAD $400 to $600 annually.
$400 to $600 a year.
Per user, yeah. And to put that into perspective, that's significantly higher than many comparable European markets. It shows not just high participation, but a real willingness to spend. It's a very high-value customer base.
Okay, let's unpack this then. If the money is that good, if players are spending up to $600 a year, why isn't this a perfect 10? What is this regulatory issue that's so severe it drags the score all the way down to an 8.2?
It's because the regulatory headache is real. It is the single biggest hurdle, and we've started calling it the two Canadas problem.
The two Canadas problem. That perfectly captures the legal split we saw in the source material.
It does. Fundamentally, Canada is not a single jurisdiction for iGaming. The federal government sets, the high-level criminal code, but gambling is regulated almost entirely at the provincial level.
Which creates this massive fragmentation.
Massive. It means operators face two completely different market entry strategies depending on which province they're looking at.
And here's where it gets really interesting, because you have to contrast those two main models. On one side, you have the truly open market, which is basically just one province.
Ontario.
Ontario is the game changer. That province, under iGaming Ontario, created a clear, viable framework for private operators to get licensed.
So if you're a big international brand, you can set up shop, pay your fees, get your license, and you're operating legally. It gives you clarity.
Regulatory security, yes.
Yeah.
But then you have, the rest of the map, the monopoly provinces.
Right.
Yes. Provinces like British Columbia, Quebec, Manitoba, they all maintain these really deep-seated government-run monopolies. They rely on their own crown corporations.
Like Lotto Quebec or BCLC.
Exactly. They run the only officially sanctioned iGaming sites within their borders.
So an operator sees a lucrative market in, say, Vancouver or Montreal, but they can't just apply for a license like they can in Toronto. What does that mean for them? This is where the risk just multiplies. It does. The critical risk warning here is that private international operators cannot get local licenses in those monopoly provinces, period. This leaves them with two pretty uncomfortable options.
Okay, so option one is?
Option one is a complex, high-friction B2B partnership with the provincial crown core themselves.
Yeah.
They're essentially providing services to the government monopoly.
Which I imagine involves a lot of negotiation and limits your flexibility.
A ton. And then there's option two, which has been common, but it's quickly becoming untenable. And that's the legally gray operating model.
Ah, the offshore sites.
Precisely. Operating from offshore, accepting Canadian players from outside Ontario, and basically just hoping the provincial authorities don't focus their enforcement on you.
But the key shift we found is that the tolerance for that gray market it's just vanishing.
It's rapidly diminishing. As the licensed Ontario market matures, Authorities across Canada are showing a lot less patience. So if you're running an unlicensed site today, you're facing increased scrutiny, potential blocking, and some significant financial penalties. It's just not a sustainable long-term strategy anymore.
So the regulatory ambiguity that might have been a loophole 5 years ago is now a very, very high-stakes bet.
It's a bet most serious operators are no longer willing to make.
Okay, so we've established the headache of fragmentation, but let's get back to why operators even tolerate it. It has to come down to the consumer, right? We mentioned the high ARPU, but what's the profile of that average Canadian player that makes them so valuable?
It all connects back to that strong middle class we talked about. The median household income is high. It's near CAD $75,000 annually.
So high disposable income.
A lot of disposable income for leisure and entertainment. The market isn't struggling. It's robust. It's built on solid spending power.
And that financial maturity is kind of mirrored in their digital maturity. They aren't just consumers, they're tech-savvy consumers.
Oh, absolutely. Digital literacy is through the roof. Over 60% of Canadians have post-secondary education, which makes them really receptive to new, complex digital services. They spend a lot of time online. The average is over 6 hours a day.
And the infrastructure is there to support high-quality gaming. We noted the really rapid expansion of 5G.
Which is now over 70% of the population.
Yeah.
And that's crucial for the modern iGaming product. When you're talking about real-time sports betting or high-def live dealer games, you need that low-latency, high-speed mobile infrastructure.
The tables are on mobile.
Heavily.
Yeah.
They favor mobile platforms, and that 5G rollout directly improves the player experience, which boosts engagement, especially during those peak evening and weekend hours.
And what are they actually playing? What are they spending that ARPU on?
They're diverse, but two big categories drive the revenue. Sports betting has about 35% participation, huge interest in the NHL, NBA.
All the U.S. leagues, yeah.
And then online casino slots, table games, is right behind at 30%. So any successful operator really needs a strong offering in both.
Now, let's get into a detail that often trips up international brands. Payments. If you get this wrong, you're just leaving money on the table. What is the non-negotiable requirement here?
The non-negotiable is Interac e-transfers. Full stop.
Even over Visa and MasterCard.
Well, Visa and MasterCard still dominate overall online transactions, maybe 50%, but Canadians have this deep trust and preference for the domestic Interac system for bank transfers.
And why is it so vital for iGaming specifically?
Because it's dominant, it's secure, and crucially, it's known to be gambling-friendly. It allows for fast, secure bank-to-bank transactions without players needing to expose their card details over and over. If an operator doesn't integrate Interac, they're turning away a huge, high-value segment of the market. It's a core technical hurdle for entry.
Okay, so the demand is high, the player value is robust, the infrastructure is modern, the revenue potential is clearly there. But let's transition to the financial reality. What makes the underlying economics actually sound for an operator with all this fierce competition and the regulatory mess?
The anchor that makes the market viable long-term is its tax competitiveness.
That sounds dry, but the numbers here tell a really compelling story when you compare them globally. Talk about the GGR tax rates.
So the gross gaming revenue, or GGR, tax rate is highly favorable. It's typically in the range of just 12% to 20%, depending on the province.
12 to 20%.
Yeah, and our analysis showed this is a massive differentiator. When you look at established European markets, you often see GGR tax rates of 30, 40, even 50%.
Wow.
So Canada's low tax burden acts as this huge incentive. It basically frees up cash for higher marketing spend or better player retention.
So Canada is waving this flag saying, come here, your profits will be taxed less. But that tax break comes with these immense operational hurdles, especially in Ontario where you have to be licensed. Let's talk about the hard costs that filter out the smaller players.
The initial investment is substantial. We estimated somewhere between CAD $350,000 to $800,000 just for the initial setup.
And what does that cover?
That's your licensing robust legal counsel to navigate the fragmentation and all the specialized tech integration we talked about. The license fees alone are high, CAD $100,000 up to $500,000.
$500,000 just for the license?
Potentially. And it's not fast. Obtaining that license typically takes a serious operator 3 to 6 months. That commitment alone filters out a lot of the less professional entrants.
And once you're in, the ongoing costs of just acquiring players are skyrocketing.
They are. The customer acquisition cost, the CFE, is rising rapidly because of the saturation in Ontario. We're estimating CAC is now between $300 and $600 head.
Wait, $600 to acquire a single customer? When the ARPU is between $400 and
Oh,
$600,
exactly.
that implies if you don't have impeccable retention or if your players churn quickly, you are operating at a massive loss early on.
It mandates a focus on high LTV, high lifetime value customers. You need deep pockets and really efficient marketing just to survive that initial land grab in the licensed market.
And beyond the marketing, there are all the mandatory compliance demands. It's not enough to just be licensed. You have to adhere to these extremely strict regulatory frameworks.
That's the core operational burden. The responsible gambling, or RG measures, are strict. You have to implement active self-exclusion programs, rigorously enforce deposit limits, provide mandatory reality checks.
Right, the pop-ups telling you how long you've been playing.
Exactly. And that requires constant technological monitoring and staffing, and that's before you even touch financial security requirements like KYC and AML,
Know your customer and anti-money laundering.
which are equally demanding. These aren't just checkboxes. They add high ongoing operational costs through specialized compliance staff and advanced tech.
And finally, localization. It's not just about flipping a language switch to French.
Not at all. You must support English and French, yes. But beyond that, provincial regulators have strict advertising controls.
Yeah.
They limit celebrity endorsements, they restrict content that might appeal to kids. Your generic international campaigns are basically useless.
You have to build a Canadian campaign from the ground up.
You do. Success requires truly localized marketing that respects both cultures.
So, if we connect all this back to the bigger picture, what is the final verdict from our research team on Canada?
The final verdict is firm. Canada is viable, but competitive. It's one of the most attractive global markets because of the low tax rates and that incredibly high player value.
But
But it is only feasible for professional, licensed operators with substantial capital. We estimate you need $2 million plus for a serious entry into Ontario, and you have to be prepared to handle that multi-jurisdictional fragmentation everywhere else.
and that fragmentation isn't just a business hurdle you can write off. It's a serious legal issue for the executives of unlicensed operations who think they can just dodge the rules.
That is the critical risk takeaway we found. The complexity of local presence requirements, combined with the fact that Canada has active extradition treaties with the US, the UK, the EU, it means that executives of these gray market operators face a medium personal liability risk. That regulatory fragmentation could literally follow you home. It's a serious personal risk, not just a corporate fine, if you try to take the easy, unlicensed path.
A very serious thought for anyone operating in that gray space. We are the Gambling Databases research team, and in each country report we do, we explore these key aspects: local regulations, tax, player experience, operator conditions.
And all the emerging trends. Our goal is just to provide that clear, data-driven understanding of how the industry functions in each market and what makes it unique.
For the full text of this and other country reports, you can visit our website at gamblingdatabases.com.